Well, thank you, Amy, and welcome everyone. Thank you for taking the time to join us today. We're going to spend the next few minutes talking about 2020 and the markets, the economy, really what's been happening year to date, give you our perspectives on that, and then we'll pivot and talk a little bit about what do we anticipate as we move to toward the end of the year, and what would be some things to be mindful of. Normally when Darren and I put these market updates together, we're doing this via a recording. And so that lends us the opportunity to pause if something doesn't come out right, or we don't say something the right way. We can stop and re-record it to get to the final product. This is the first time we've done this live, so bear with us as we work our way through this. But one of the things that I think it does lend itself to is the ability to be interactive. And so, as Amy said, we do encourage you to use the Q&A function of the platform, ask questions. We'll do our best to respond to those questions, maybe as we're sharing the material with you, or we'll defer and answer questions at the end of our time together. So my name is Brad Kelly. I'm the principal in charge of Eide Bailly Financial Services, and joining me today, as always, when we do these market updates is Darren Pladsen, Director of Investment Strategy here at Eide Bailly. We have a special guest today. Dana Dioria is joining us, and she is the Managing Director of Symmetry Partners. She is coming to us live from Glastonbury, Connecticut, where the Symmetry offices are located. Symmetry is a firm that manages over $9 billion in assets under management, and they've been a strategic partner of ours for a number of years. We really leverage them and their research capabilities, and they assist us with building and overseeing the portfolios that we bring to our clients. So Darren and Dana, thank you for joining us today, and I'll kick things off by Dana just asking you, we've been through quite a year this year. It's been somewhat of a roller coaster ride in the markets and the economy. How would you put this into perspective and characterize this? How would it compare to maybe other market events in the past, or is this really unique unto its own?
It's a great question, and thank you, first of all, for having me here. I can't say enough about the partnership with Eide Bailly and what stellar team that you've put together at Eide Bailly, all of the advisors I meet there, which says something tremendous about the work that you guys do. So I'll answer the question the best that I can. I would say that every market event is different, and yet markets continue to go up. So, if we zoom into the current market, I can point to a lot of differences, even with some of the more recent market downturns, big market downturns that we've experienced, like 08 or the tech crash, right? The tech wreck. I think the big differentiating factor maybe in this case is that it is both a supply and a demand shock to the economy, which is a little bit unusual. It's relatively rare. So obviously you have people at home, if they're not quarantining, they're sort of staying home because there's no place to go. And so certainly we've seen demand drop dramatically, but also, COVID-19 has affected supply as well. And so it is unique in its sense, but as I say, every event is unique. And, we have a great slide that I'm sure Eide Bailly advisors have leveraged in the past, which is kind of showing the timeline of terrible things that happen, in the economy, and yet markets kind of just trend up over time. So if you zoom in, yes, differences. If you zoom out, it's another event that unfortunately we all have to live through. It's a health and human event in this case that, everyone has to kind of deal with in that respect. But at the end of the day, we expect markets to recover and to trend up over time as they always have.
All right. Well, thanks, Dana. Amy, let's move to our first slide. And Darren, let's just summarize what the markets have done year to date, both in the equity markets and in the bond markets from a global perspective. I know these slides are updated through the end of second quarter, but Darren, why don't you share with us what you've been seeing and what's happening so far?
Sure. And thanks for having me too, Brad. I really appreciate you re-inviting me. It's been a few months since we've done this. So just kind of a couple things you can see in front of you. And this is end of Q2, which is the end of June, of course. That first box is the actual quarterly return. So US stocks, and the index we're using is a broad-based index. So it's actually 85% of the US companies that are we're showing a return from. Actually up about north of 21% international stocks, and that is really Europe, Australia, Far East, the EFA index, up 15%. In emerging markets that quarter also had quite a rally, along with the bond market. And you can see the US Treasuries, US corporate bonds, and international bonds all across the board performed very, very well in Q2. If you drop down a box to the year to date, a little different story, but I do want to give you some more current numbers, and I'll kind of go quickly across that. But US stocks, and again, that's roughly 80% of all US publicly traded companies, actually up about 6%. The EFA, or the international stocks, actually they went from being down 11% down to about -6. And then emerging markets, same thing. They were down at the end of June about 9.6%. Now they're only down about 1%. Emerging markets, those are companies like or countries of China, India, Russia, Brazil, those type of countries, roughly speaking. As I flow a little bit further, I'm not going to cover this whole chart, but US Treasuries have had a great year, along with corporate bonds and international bonds. And primarily, if you think of the 10-year Treasury, I talked a lot about this, where it was at the beginning of the year, north of 1%. Today, we're at 0.65%, an inverse, kind of, not really an inverse relationship, but you would think it kind of is. But as say an index drops in the bond market, or the Treasury drops, it has a positive effect on total return, typically in the bond market. So that's that. Brad, do you want me to jump into valuations maybe a little bit?
Well, let's talk a little bit before you do that. Let's talk a little bit about, just as you dig deeper down into the returns year to date. I think everyone on the call probably knows tech has been a big driver of that, but talk a little bit about the sectors and what sectors have rebounded and which ones are lagging. And are we seeing, and Dana, you could even jump in here too, but are we seeing any kind of rotation yet that might be happening at the sector level? Maybe just share some thoughts on that.
Yeah, just real briefly. I mean, obviously, or hopefully everybody understands that tech is really, really driving the returns in this market right now, which is primarily the NASDAQ index. And that's what we're seeing a lot of. It's hit all-time highs. But the big tech companies are really driving it. So tech, also consumer discretionary, has been a leader thus far in this market. The laggards are energy, financials, which kind of appropriately, and we all understand that, especially when rates come down, typically financials will get squeezed and won't have as great a returns as usual. But yeah, in a nutshell, tech is the driver. Like I said, consumer discretionary, and even healthcare is starting to pick up, which also makes, I think, a lot of sense with COVID and what's going on. Well, yeah, I'm sorry, go ahead, Brad.
Yeah, Dana, anything that you're seeing at the sector level that you want to share?
Yeah, I think Darren hit it on the nose. Just was looking at the Wall Street Journal, and Apple's market cap has hit $2 trillion. So talk about large tech companies driving what's going on in the market. This is what we call in the industry a top-heavy market, meaning that you have a very few set of stocks driving all the return. And when you think about how market weight indexes work, the companies that have the highest price and largest weight, if they're returning well, they can pull the whole thing up. Of course, that does lead to some idiosyncratic risk or specific risk of, you know, let's say a regulatory announcement that's not favorable to these large tech companies, or really just given the fact that their prices have been bid up so high, are they able to kind of give a return commensurate with that? I think it's probably not controversial to say tech will probably continue to do well when you look at the companies, right? When you look at their profits. But to be successful in investing, it's not just a matter of looking at what the profits of the company will be. It's how much you have to pay to get those profits. And we're at a point now where the valuations, right? The price of those tech companies is pretty high. And so they have to keep, you know, I've heard a nice analogy for this. It's, you know, the Patriots are a great team, but at a certain point spread, even the Patriots, you don't want to bet on, right? So the question for investors becomes, you know, are tech stocks going to continue to drive returns? And our answer in this case, as it often is it's hard to say, and you should probably diversify the risk of any one sector.
Yeah, so, you know, that leads to, you know, with the run up that we've seen in certain sectors and the market as a whole, you know, the price of the market always reverts back to earnings at some point. And so, you know, what's driving this growth? Is it revenue growth? Is it earnings? Is it, I mean, what is it that you guys are seeing that's driving the growth of the market? What's the news that's driving it? And do you think from a valuation standpoint, how is the market valued right now? Would you say it's fairly valued, overvalued? And I know interest rates even have a component of market valuation as well.
Yeah, kind of along Dana's tune of are we fairly valued, overvalued, and where is tech? We'll keep talking about tech for now. Kind of go from here. If you look at the S&P 500, the 500 largest U.S. companies, the PE, the current PE, I should say the forward PE, and that is analyst estimates of what they're anticipating going forward over the next quarter, 12 months. We're right around 22 times earnings. The 25-year average is about 16.5 times earnings. So we are in the S&P 500, what looks like to be overvalued. Now, I've talked to Brad about this a number of times. Maybe our world's changing. If you think of, you know, it's P divided by E, so it's some fairly basic math, even though I know some people maybe have struggled with that numerator denominator in the past. But if you think of what a lot of tech companies also do, they do take portions of their E, and right now my belief is it's kind of a race to more knowledge and better technology. So I'm seeing, or I think I'm seeing, a lot of dollars, R&D dollars, that should go to the bottom line being displaced or reallocated amongst these big techs, so they don't show great earnings necessarily. So that's just, I guess, Darren's point of view. But right now, I think generally speaking, I do feel we're overvalued, especially tech. There are certain sectors or pods that truly are deep value, and they are undervalued right now. Dana, I know you'll talk about that here in a little bit. Brad, from an interest rate, I'll let Dana jump in here too, but from an interest rate standpoint, all of it kind of intermingles. When we have low interest rates like this, like we do, and we saw the Fed in February and March really go from 1.75% on their overnight lending, basically down to 0 to 0.25%. I mean, they brought it all the way down really, really quick, which I believe, I think I know, has definitely helped bond returns. But it also, I think, has propped up stocks too.
Yeah, interesting point too, Dana. Maybe just a quick comment on the role of the Fed in 2020, because the Fed has had a significant role in what's happened in the markets. Have even done things that have been unprecedented in injecting liquidity into the fixed income market. But do you want to touch on that and just how that plays into where the market is at today from your perspective?
Certainly. So the Fed, as Darren mentioned, has dropped rates. They've indicated they have no intention of bringing them back up anytime soon. They have indicated that they don't intend to go into negative territory, which we have seen in some other countries. Obviously, there aren't any guarantees when it comes from the Fed. But they do seem to be sticking to that they're not interested in taking the US into negative interest rate territory. And to your point, they've also done a lot of bond buying. They've even started buying ETFs in order to kind of inject liquidity. So a lot of work on the part of the Fed. I think a lot of folks are expecting Congress to step in with another package. That hasn't happened. So the Fed, so eyes are kind of turning to the Fed as to keep this going to a certain extent. A couple things I would say, we talked about sectors a bit. Technology is a growth sector. So by that, really definitionally what we mean is just it tends to be higher priced to begin with relative to its earnings. And in a low interest rate environment, that tends to be good because they tend to be borrowers. So I think Darren's point is quite, you can't not to predict, but I agree with, kind of the point that he's making about the potential that tech is a little overvalued, that it enjoys these low interest rates to a certain extent, but that kind of can't go on forever. The FOMC did meet today. There didn't look like there was any big news coming out of that conference. But again, we don't expect a change anytime soon in their posture to keep rates very low. And that, to a certain extent, I think one thing worth as investors understanding is, there's an element of what's called financial repression when things like this happen, where, if you're a saver, you're kind of paying a little bit, right? Because when rates are reduced, we have a lot of borrowing going on to fund all these programs. But, there's also then an impetus to a certain extent for rates to stay low and the borrowing costs for the government to stay low as a result. So who kind of pays for that at the end of the day is the saver. And it becomes very important when you look at what your rate of return might be over the time horizon. And all the more important to have a financial advisor in the mix, helping you to kind of get a better sense of maybe what your asset allocation should be, how much risk you should be taking, how you can diversify into different areas in order to potentially take advantage of incremental returns that might be available in certain areas. We'll talk about factors in a minute. And just to get a realistic picture of what, the medium to long-term horizon might be for your return.
Yeah, it always comes down to good, solid planning at the individual level to determine the right strategy. So you mentioned factors. Amy, if we move to the next slide, let's just drill into this a little bit further, where return has been coming from. We are factor-based investors. We subscribe to factor-based investing. So Dana, maybe just a quick, what is a factor? And then take us through how the various factors have performed for the year.
Sure thing. So a factor is at a base level just a source of returns. It's kind of they're called style factors, and really when academics have looked at markets, and even I would say the industry, right, active management and all that have looked at markets, they've identified certain anomalies or variables or patterns, however you want to call it, that tell you some information about returns in the market and why certain stocks outperform other stocks over time. And so if you look at the slide you see in front of you, it lists the equity or the stock market factors that are we pay a good amount of attention to, and that the industry in general has kind of decided are very meaningful. And you see there value, size, momentum, quality, and minimum volatility. So I'll take a quick minute to just run through these. Value means simply low price. We talked about this already. It's lower price stocks relative to higher price stocks. And it's the price, you're looking at that price, you're determining its low price relative to some other fundamental measure of the company, like its book value or its sales or its cash flows. Size just means small companies versus large companies. Momentum means companies that have been doing well in the stock market lately tend to continue to do well for a period of time, versus companies that haven't been performing as well in the market. They tend to keep going down for a little while or not going up as much. And then quality talks a lot about profitability. So companies that are more profitable tend to have a better return. And finally, minimum volatility means companies whose stock price is less volatile, is not bumping around as much as other companies, tend to have better risk-adjusted returns, meaning They may not return more than the market per se, but they, relative to the risk you're taking, they are a better investment sometimes, and particularly in environments like we're in. Although interestingly, what you might see there is that minimum volatility in this particular period hasn't necessarily paid off, but another defensive factor, quality, has. So higher quality stocks have done well. Momentum has done well in this market. Value and size, which are probably the most traditional factors, they're sort of the original factors, have not performed well in this market. So this is an interesting, and it goes along with the technology discussion that we just had. So lower price stocks are underperforming higher price stocks. You think of the tech stocks that Darren mentioned. These are high price stocks, and they're still continuing to kind of blow it out, right? Crush it, if you will. And so their multiples just keep getting higher. Brad mentioned earlier what's driving the return. Their multiples tend to continue to increase, which means their price keeps getting driven up relative to their earnings. So we are seeing a period where size, small company stocks that usually outperform large company stocks are not doing so as much year to date. And value stocks, lower price stocks, are not outperforming higher price stocks. But this is the performance currently. Of course, these factors are not working in every period. If they did, we'd all do it. We'd all be rich. We wouldn't need to be here. Unfortunately, it doesn't work that way. These factors are long-term prospects, and you kind of stick with them, and they tend to pay off over time.
Yeah, so it's probably easy to get caught up in, if you're looking at what the NASDAQ is doing, which is tech heavy, but in your portfolio and a person's portfolio, if you're diversified in value and small cap stocks and international, you're probably lagging a little bit in return this year relative to what the NASDAQ is doing. So it's important to keep that into perspective. Are we seeing any kind of rotation? Either one of you, do you anticipate any rotation? We've been waiting for value to rotate over growth for many years now, but could this year be the year that triggers the rotation?
Go ahead, Dana.
I'll jump in, but then I'd love to hear Darren's comment as well. I'll simply say, unfortunately, value thus far has actually suffered even worse. So at the end of last year, the spread between value and growth had gotten wide enough that a lot of folks in the industry were saying, oh, it's time to load up on low price stocks because they're poised to come back in a big way. And then COVID hit and everybody went home and they're all online. And technology companies are, the only place to be. And then oil got hit, which tends to be value. And Darren's point on financials. So it's just sort of the perfect storm, I guess, is a term you can use. So value really hasn't obviously come back yet this year. We're not, there was a brief period where value got really hammered and then it came back a bit, but it still hasn't really, been able to claw back relative to growth. The question, what about the remainder of the year? It's certainly possible, but when you're looking at short term, 6 months, it's virtually impossible to say, right? If there's any chance it comes back this year. What we can say with some confidence, and this is, Darren said that, these are opinions, right? So this is Dana opinion. Do I think over the medium term value comes back? I do. I don't think this sort of thing goes on forever just based on historical performance, but whether or not it's this year, it's really hard to say. Darren, what are your thoughts on that?
Kind of along the same lines, Dana, and just kind of a few stats that I like to throw out there. You look at size and value, especially the two factors on the left side. Historically, small caps have led us out of a recession. We haven't seen that thus far. The other, I think, maybe potential problem we have right now with size, and again, the small caps primarily, we might see some bankruptcies yet, and we've probably already seen some. So that is, kind of to be continued. So that's that. The other thing I think is so interesting along Dana's point of value, you can go back the last 40 years, every 10 years, this rotates from growth to value. And we just came out of a heavy growth. And I look at that momentum column because I, even though it's not all growth, but I like to look at that and say, we had a growth type decade in the teens. The lost decade was a value decade. The 90s was a growth decade. The 80s was a value decade. So I'm not good at predicting anything, but I'm just going to say you just never know. So anyway.
Those are
Yeah.
great.
To,
Can I throw
yeah,
one other?
yeah, go ahead, Dana. Go ahead, Dana.
I was going to say same thing on the international to domestic side. It's a great comment. It's very, you know, these things are cyclical, and we've seen US doing very well. And, you know, valuations are higher there. And, you know, the expectation at some point is you're probably going to see a reversal there as well. Sorry, Bob, go ahead.
Yeah, I was just going to say, I mean, one of the market events that dates some of us is back to the tech bubble that happened in 2000, and growth led us up into that bubble. We had 10 years thereafter where the S&P provided no positive rate of return. It was flat over 10 years, but value stocks did provide a positive rate of return. Question is, I'm not asking you guys, but the general question is, are we heading into another tech bubble in the foreseeable future? But that remains to be seen, and we'll save that for another call. Let's, Amy, move to the next slide. And this is a busy chart, but one that we use often, and it is the kind of back to Dana, your comments about diversification. Darren, do you want to just take us through this slide, what we're seeing here, and what the story is behind it?
Sure. So this slide basically goes back to 2008 through 2019. The best performing asset classes on the top, the worst on the bottom for that given year. And then you can color code everything on the left with different asset classes. You know, the whole point of this is, you know, what do you do in times like this? I mean, we're going through COVID, election, we're coming out of tariffs. I think everybody forgot about what was going on in November and December of 19, where every day it was tariff talk. And we were kind of coasting, quite frankly. We were just coming out of a great year. I remember February 14th of 2020, I believe we were up 28% in 19 and up 4% year to date, and everything changed. But to my point, what do you do in situations like this where we think we know where this market's going, but we really don't have a good handle? You diversify, and that's the black box. And it gives you a fair rate of return. And I say this all the time for people that have seen me on these economic updates. The whole point of this is financial planning. Do your financial planning. You can forecast from that point what your goal, or not even the goal, but the target rate of return is that you should have to fulfill your goals. So that's my quick and easy on this chart.
Dana, anything to add to that?
I think it's right on. And, you know, the academic work on this is that, you know, things like valuation ratios and where we stand are decent indicators for what your expected return might be in the medium term. They're not great for, you know, short-term timing. And, you know, I imagine if you're not in the industry and you look at a chart like this, you say, you know, isn't there a way? I mean, certainly it's all over the place, but can we get in front of it? And it's just, stock markets are leading indicators. So the stock market is usually in front of you and the measures that you have to try to time. So that's why you kind of end up with these, you know, kind of issues where you can't get in front of it, so you diversify across it.
All right, so speaking of diversification, and Amy, maybe we can stop sharing the slides now at this point and go back to full screen. So we're getting, we've got one question in here that's related to Bitcoin. And it's kind of directed back to Dana, your comments about low interest rates, the negative impact it has to savers, and really the dollar kind of in the backdrop of the dollar, the valuation of the dollar. I mean, how do we view Bitcoin? Because Darren, I know we've talked about it. It's viewed as an alternative strategy to really diversify away from the equity markets. Just share some thoughts on Bitcoin.
Sure. I would say to you that Bitcoin, because it's kind of what I would call an alpha thesis, we don't directly address it in the portfolios. And I'll explain what I mean by that. we look to do broad asset allocation across geographies and across these factors. And we, Bitcoin is, sort of a specific issue, right? So in other words, Bitcoin may or may not end up paying off. It is going to be worked into your investment via the companies that are using Bitcoin. If Bitcoin begins to become more a part of the economy, it's going to be worked into your portfolio. We won't take a specific position on Bitcoin. That being said, I will say the concern that you're raising, we think is, certainly very valid. And our answer to that concern is to be diversified across companies, sectors, industries, economies, geographies, right? So if we have interest rates in the US being pressed down, that decreases the attractiveness of the US dollar. Of course, overseas is pretty depressed at this point as well. So they're sort of, at this point, just equalizing. But, certainly it means a devaluing dollar. So our answer to that is, the antidote to a specific risk like that is diversify across different economies. It may be the case that we're kind of stuck with what we're stuck with in terms of interest rates for a fair amount of time, that there's no place to go. When we were on the factor slide, we kind of moved over it, and I didn't hone in on it, but there were two fixed income factors you might have seen there: interest rate and credit. Interest rate is, the duration of your bond, right? So how long have you lent the money out? How long is that bond? And credit tends to be well correlated with stocks because it's what's the default risk. So what you saw was, and I think Darren mentioned this earlier, as interest rates have been falling, interest rate risk has paid off, but credit risk year to date is still negative, just as stock markets are a little bit negative. In the second quarter, that reversed a bit, but not enough for the year-to-date perspective. So having bonds overseas as well certainly is diversifying some of that risk, the interest rate risk that you see in just US bonds or the credit risk that you see in US bonds. So long-winded way of saying it's absolutely a concern, and we do think that that is one of the reasons that you want to diversify your investments.
All right, great. We've got more questions coming in. So Darren, maybe to you, how much of the overvaluation of the market is due to investors taking cash that they had in bonds and just going into the equity markets? Certainly there were buys, good buys in the market in March and April. So cash moving into the market, how much of that is contributing to the valuations?
Yeah, I don't know that I can put a number on that. I would say a decent amount. I mean, we're seeing Robinhood accounts pop up. I think I heard something the other day for the quarter. In the industry as a whole, there was X amount of accounts opened up. And if I heard that right, I think Robinhood had 50% of that number, which is unheard of. So you're seeing certain type of investors definitely trying to move into this market. This is kind of the Portnoy, the guy on Barstool Sports who's tweeting all the time about all of his great picks, and a lot of times he brags about not even knowing what the ticker or what the company is, and he's just picking 4 letters. And I think there's some of that. I don't know from a valuation standpoint if that's making a huge impact. It might be making a little bit of an impact, Dana, because at the end of the day, it's supply and demand. If there's dollars flowing, should be moving the price of that security up. So Dana, what's your thought on that?
Yeah, I think you're absolutely right. Money has flowed into market weight indexes. That's part of the reason, you're seeing, it's easy now to put your money in an S&P 500 ETF. It's commission free. It's pretty quick. And I don't know that, a lot of folks realize that might be a more concentrated investment than they think. And then there's also the case that there's still a lot of money on the sidelines in terms of flows into mutual funds. You're seeing a lot of flows into bond funds this year. And, equity funds aren't getting as much in the way of flows. If you think about long-term perspectives where this sort of thing is going, it suggests that, more passive, more low-cost ETFs, et cetera, probably tend to dominate a little bit relative to, say, active management, which, I mean, we have yet another example that there wasn't a lot of great timing with respect to active management in this case. So yeah, I think 100% we saw retail assets driving, so individual investors driving that push into the S&P 500, probably because the market dropped so violently. I think people saw a buying opportunity, right? Buy low, and the easiest place to get into is like an S&P 500 fund.
Yeah, I think that you're right. But I do think there's still a lot of cash on the sidelines as well. You know, I've got two questions here that are somewhat related. You know, money's been flowing into the equity markets. Money's been flowing into precious metals as well. We're seeing gold, right, hitting historical highs as well. And so question is along the lines of what's your outlook on gold, and how to kind of put that in the context of the federal debt. I've got another question related to, which again is a hedge towards this topic, inflation. Where do you see inflation moving toward in the next 2 to 3 years? So any thoughts around gold and what we're seeing there, and then long-term inflation?
Yeah, I'm happy. Darren, you want to kick this one off and I'll...
Sure. Well, you know, I'll give you kind of the canned answer. Gold, along with any type of precious metal, is a great way to diversify your portfolio. As far as forecasting a number, I don't know that I have a number. I do believe it can go higher. And I because of the question and how the question was asked, I do think we have some sort of issue, potential issue. And I don't know when this is going to come to fruition, but with the amount of debt we have and the ability, or the ability of us continuing to print money, you would think the opposite of that would be gold. And that leads to, I think, inflation, Brad. You know, what do we look like in a year or two from now? I do believe, however, the disclaimer is, I've said this for a number of years, I do believe inflation does have to creep up. At some point, I've got a sense that, you know, and I don't know how high. I'm thinking we got to be probably north of 3% at some point, and right now I believe we're at 2.25%. You know, the way they're measuring it. So that's my take on kind of both of those. I'm not giving great answers because I don't have a surefire number, but.
Yeah, well, wouldn't you think with all the stimulus that the government's been doing, I mean, a byproduct of that could be inflation, right? But Dana, any thoughts that you have? And then we're going to get some political questions coming up here in just a second as well.
Yeah, I think Darren's point, you know, gold, precious metals, commodities in general have been a diversifier. You know, my answer on that relative to inflation, and this is a bit technical, but if you're worried about inflation in the short term, your best hedge for that is TIPS. There's been some research done on this, and inflation protected securities, which are actually driven by the inflation rate, are a nice place to go if you're looking at short term being, you know, compensated for unexpected changes in inflation. Expected changes in inflation, you're compensated just in regular taxable bonds. But, you know, even stocks, if you're not worried about keeping pace with inflation in the short term, if you have stocks in your portfolio, the idea is that they will too be able to pass on, you know, those productive enterprises will pass on those additional costs, and you will still get a return that, you know, it pays you back on inflation. So long-term versus short-term view, you know, going on that perspective.
Yeah, and comment along those lines too that I think reinforces this. So, you know, as the Fed, the government's been printing cash, Darren, as you said. I mean, that does kind of devalue the dollar. Does that then make international stocks a little more attractive right now? Of course, when we invest internationally for clients, we're investing in U.S. dollars. Lower dollar valuation tends to create a more attractive return opportunity for us. But any thoughts there along those lines?
Yeah, you know, Brad, I say this a lot in our presentation. There's well, at least 3 parts of return on anything you buy, right? Any type of asset, whether it's your house, whether it's a stock, whether it's gold, whatever. One is appreciation, just the price at the beginning of the year to the end of the year, however you measure it. The second part is distribution, the yield that's getting kicked out. The third part is currency play. And that is, let's say we're going all in on international. What does the US dollar do relative to the yen, right? Or the euro, or whatever currency we're relating that to. So there's a portion of return on that play too. So I mean, currency, if the dollar declines relative to any other or every currency out there, the value of that asset or those foreign assets should go up. So yes, kind of a long-winded answer to your question.
All right. So we have an election this year. I don't know if you guys were aware of that or not, but thoughts on, not necessarily, just historically, any perspectives that you can share as far as, you know, when one party has control of the House and Senate, or House, Senate, and the White House versus split. Just any feedback, comments on the upcoming election and maybe the results of that and what that might mean to the markets. I know we have to be a little sensitive here, but I do think there's some information we can share that would be helpful.
Oh, Dana, do you want to lead or do you want me to?
Whichever. You go ahead.
No, you go ahead.
Well, here's we've actually looked at what research exists on, you know, and actually I think it's more the presidency, although there is some information on, you know, who's in power in Congress. But basically the upshot is there's really not a good correlation there. You know, so in other words, it's not whether it's a Democratic president or a Republican president. I think, you know, the data that I've seen, Democratic presidents, market does slightly better, but it's not a statistically significant number, right? It's just, and you think about it, it's just probably by chance. The other thing that you'd say is, you know, the measures that one administration puts in place, by the time they actually filter into the economy and start taking effect, there's an argument to be made, and several people make it, that, well, actually, it's the next administration that maybe is benefiting from what happened from the administration before. You know, the pundits predicted a massive drop in the market when Trump was elected, and of course, we saw the exact opposite. So, you know, this, like so many other things, will the election have an impact? For sure. Is it a predictable impact, and how will it pan out over the course of 4 years? There's not a lot in the historical record that gives us indicators about, you know, just based alone on party, about what, you know, to expect on that.
Yeah, and kind of along the same lines, I've looked a lot at this just because I have a lot of clients. Brad, we've talked about this. Usually one of the first questions we get from clients is, what's going to happen to my portfolio in November? Regardless of what political party, what affiliation, I think everybody's concerned about that. And when you go look at the data and the research, to Dana's point, there is really no statistically significant, and I've even taken it a step further, with a Democratic president and a split House and Senate, or Republican split House and Senate, it really doesn't matter. I mean, the market does, in my estimation, the market does what the market does. You know, one other thing, being we're in a CPA firm, and we, you know, a lot of CPAs on the call right now, people tend to think that instantly tax law changes are going to change. Keep in mind, Obama in 2009 had complete control of the House and the Senate. It took him till 2013 to overturn the Bush tax laws. So it does not happen overnight. It takes usually a long period of time. This might be a little different. There might be a quicker change in corporate taxes depending on how things play out, but I can't predict it. And as I say all the time, the market is still a market full of companies that will adjust to whatever administration and whatever policies are thrown out there. It's happened for 95 years, 100 years, 150 years, and I believe it'll continue to happen.
Well said.
Yeah, bottom line, as a capitalistic society, a society built on capitalism, the markets will adjust accordingly. All right, I think we've answered all the questions that we have. So I'm just looking through here one more time. So maybe to wrap things up, I mean, what do you guys see as we look ahead to the end of the year? You know, what are some risks that you see out there? What would be words of wisdom that you would share with the group, the folks that are on the call, as we kind of head into year end? Any final thoughts?
Yeah, I'll kick it off. The COVID is obviously going to drive what happens. So we get a lot of economic information from a lot of different sources, and everybody, as you can imagine, caveats everything they say with, oh, my light keeps going out, pardon me, with, you know, it depends on what happens with the virus. Do we have another wave, right? So kind of everything you read. And what that means is there's uncertainty in the market. And I will tell you that it's hard to predict the market in a stable period. So in a period like this, where you have risk already, you have uncertainty related to this virus, trying to get in front of it, trying to pick sectors or stocks or what have you, while it may seem intuitive, you may say to yourself, well, I think this is going to pay off, right? No hoteliers, no, cruises, right? I would just, my thoughts to you would be to caution against that, unless it's your play money, right? If you have money to speculate with, that you say, hey, I think this is, you know, depressed and it's going to come back, or I think this industry's done, but this one's going to do great. But with your assets that you're investing for the long haul, for your retirement, for your kids' college, it's it surprises you, because the winners and losers are not necessarily as easy to identify as you'd think, right? The immediate obvious stuff, like the travel industry got hammered, that happens real fast. Getting in front of that is difficult. And there are just as many people who are saying, oh, I think their price is depressed more than it should be, as people who are saying, no, you know, it's going to get even worse. China, you'd think in the beginning of the year, China would have had a terrible return, and you know, they kind of came back, and that wasn't the case. So I would just say to all of you out there, a caution against, you know, putting your important money in any one concentrated bet in a market like this, or any market, but especially in a market like this.
Yeah. Thanks, Dana. Darren, any final thoughts?
Well, I think we're creeping into kind of a new normal, and that is what we're doing right now. We're on a Zoom call for the first time ever. The work from home world is changing right in front of our eyes. You know, I go back to, hey, we're a capitalistic society that believes in change, and I seriously think this is happening. And quite frankly, this gets back to the tech discussion, and why I believe tech has been the leader is there's been a little bit more vision, I think, in that world than maybe some of the old industrials or whatever. With that, I do say one thing I try to tell my clients, and it's very simple. There's an old adage, and it's don't fight the Fed. And when the Fed is doing some very unique things, well, as they're cutting rates, but also you look at what the Treasury's doing. To me, my gut is that's what's really driving this market, along with new investors. So anyway, my outlook over the next throughout the year is probably more of the same. We could see some volatility around election, maybe the month before, but at the end of the day, if you're an investor, you're investing in companies.
All right, thanks, guys. We had one more question. I think I can handle this one. It said on our last slide, we showed a 60-40 split, the black box on the periodic table. Well, was wondering what the 60 was, what the 40 was. 60 equities and 40 fixed income. So kind of a moderate type investment strategy is what that was representing. All right. Well, I appreciate Darren and Dana, your time and your feedback and comments. As always, you guys, you know your stuff and present very well. I would ask too, for those of you that attended the call today, we do appreciate your feedback. I never thought, to Darren's point of using technology, sitting in a room above my garage in Fargo, North Dakota, I never thought I would be broadcasting live in this manner, but we would welcome your feedback on the content, and this is something we'd like to do more of going forward. So any feedback you can give to us, that would be great. And with that, we'll wrap up the call. And thank you again for attending, and have a great rest of the day.
Thank you.
Thank you.
Awesome. Thank you all so much for attending, and thank you to our presenters, and you guys have a great day.